I'm glad you're mentioning that because I wanted to ask you about that. I mean, people recognize that, the market's high now. It was really low in March of 2009. That was the
Right.
bottom. And October of 2007 was the previous peak. And at that
Right.
time in 2007, how come all of these analysts and like people that are on CNBC, how come they weren't ringing bells saying, hey, everybody, it could be going down. And then we see the Great Recession. But a lot of
Right.
people were still giving recommendations of strong buy, strong buy. This is still
Right.
a good market. I think that's what you're
Well,
going into, right? Talk to
it's
us
kind of
about
like
that.
driving a car. The analogy I use, Mike, is like driving a car looking through the rearview mirror. And it's human nature to expect our recent experience to continue. And, what happens, though, is if you're on a road that's straight, that's great. But at some point in time, there's a bend in the road. And if you're driving the car looking through the rearview mirror, we all know what happens. You go off the road and you wind up in a ditch. And that typically is what happens at major turning points. So you're absolutely right. 2007, people were still bullish. I can say I was one of the few guys who was not bullish, and I was using a lot of the things that we've talked about and some that we haven't had the opportunity to talk about as to why I thought the economy was going to slow materially in 2008. In January 2008, I said we're in recession. That was months and months before people jumped on that bandwagon. And in 2009, you're right, in March, hey, the market was down. Everyone was negative, expecting things just to keep getting worse, and yet the market bottomed. So that's my point. If the market is truly a discounting mechanism, what was it telling us in October 2007? That there was no housing crisis about to occur? Or March of 2009, that the world was truly coming to an end? And the fact is, that was not the case. So the idea, and this is treated, with respect, this idea of the market is a discounting mechanism. The market is telling me this and so forth. And it's hogwash, And so to me, that's why one needs to be able to utilize contrary opinion, because when all you hear is people talking why something's going to keep going up, that's the time where you have to detach and say, okay, what are some of the reasons why that may not continue to take place? And only by doing that can you separate yourself from the crowd. It is really one of the most difficult things to do is to go against the crowd. But that's why utilizing things like contrary opinion, using technical analysis to provide, if you will, the conviction one needs to kind of say, hey, wait a second, things are weakening. So in October 2007, the advanced decline line, which I had referenced earlier, had made a peak in June. The S&P went down into August, rebounded, made a new all-time high in October, but the advanced decline line was significantly lower in October than it was in June. Why? Because a lot of stocks weren't participating, So those are the signs that the majority of the people you reference on TV, they don't pay attention to that stuff. Instead, they're saying, well, we think earnings are going to be up 8% next year, blah, 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 blah. And that's what they're looking at. So they're not going to catch turns because that's their mindset, and they honestly don't look at and take the holistic approach that I'm talking about that I really think is necessary in order to navigate the big turns that happen in the market. So contrary opinion is a tough one, but it takes a fair amount of experience and time to develop it, but it's well worth the effort.
You're right on that. And certainly we all have bias. Sometimes we don't even know the bias is there, whether it's the recency bias or the confirmation bias. We all have these things that are there. And there's a lot of psychology that goes into those biases, and then also other things that deal with the market. And there's a lot of research and study on behaviors in finance. You talk about it sometimes when you kind of discuss the idea of greed and the emotion of greed versus the emotion of fear, particularly relating to finance. And tell us about that. Briefly, give us a rundown of that, fear versus greed with finance.
Yeah, well, basically, greed is something that happens over time. In other words, everybody doesn't pile into the stock market all at once. It's over a period of time. Someone reads an article, then 2 weeks later, 3 weeks later, they read another article and so forth, and gradually they warm up the idea of, well, maybe I should put a little bit more money in that stock market. It's been going up and so forth. And when the market tops out, it doesn't just usually turn on a dime unless there's some kind of a major event. It usually takes time. And that's why this erosion underneath the surface begins to take hold in things like the advanced decline line. Conversely, when an event is going on or the market's been going down significantly, everybody's felt that sick feeling in your stomach. and it's like, oh my God, you wake up at 3 o'clock in the morning and my portfolio's down 30%. I don't know if I can take it anymore. You're not alone. A lot of other people feel the same way. And inevitably what happens is fear takes hold and panic in a sense sets in. And as prices go down, it forces even more people to panic. And that's why fear and panic, you make V bottoms. Why? Because it's like a convulsion that happens all at once. So that's the difference between in terms of how it's expressed in financial markets. Greed takes time over a period, whereas fear and panic, kind of come to a point and reach a crescendo. And that typically is what happens in the market. And momentum indicators show, wow, everybody got out at the same time. You get a bounce, and then invariably the market will go back down to near those initial lows. And what one is looking for is less intensity on the selling pressure. And that's typically what happens at every single major bottom over time. The news is still going to be ugly. It's just at the bottom, everybody who pretty much was going to sell, who couldn't take it anymore, has already sold. And as the news then gets less bad, the market takes off from there.
It's fascinating, and this is played through so many times, and it is an interesting thing. We're talking with Jim Welsh, Twitter, at Jim Welsh Macro, and he has Macro Tides and Weekly Technical Review as a newsletter. But it is interesting that this idea of fear and greed has played out so many times. And one thing that I think people are starting to talk about and observe, there's been a lot more passive investors. Oh, I just buy the ETF and I just ride it out. I'm just going to hold it. And if you've done that from 2009 up to now, it's kind of worked out pretty good because the market's had such a great run. But when we have this first kind of V bottom or big drop, what are these folks that are doing it themselves going to do? How are they going to react to that scenario? And I think if history is any judge, they're going to probably sell, and this emotion will hit hold to them, and that will be a kind of a bad time to sell, maybe. But
absolutely,
yeah. And how do you teach people and educate people through the newsletter about the different types of recessions? And that's another thing you talk about I want to get into, which is recessions, and there's different types of recessions. They're not all the same. They manifest differently. Sure. Go into that a little bit.
Well, basically, your garden variety recession is, when you get a slowdown in the economy, and it's usually, again, follows the Fed raising interest rates. Liquidity starts to dry up. You think about it, as rates go up, fewer people can afford to buy a car or a house. And as fewer people do that, then the auto companies lay people off, the housing manufacturing people lay people off. They stop going to malls, so the retailers stop buying stuff. So it filters through. And, that's your normal recession, the one that typically happens. When it develops into a financial, crisis in a way, which is what we saw, obviously, in 2008, the 1930s. 1974 to a lesser extent, where all of a sudden the banking system is really shaky. That is a whole different type of animal, if you will, and typically it's associated with a much deeper, protracted recession, and it requires a much stronger fiscal and monetary response. But the vast majority of them are the Fed raises rates a little bit too much, things slow down, and then the slowdown kind of feeds on itself, and you get a recession. The Fed then cuts interest rates, and the economy stabilizes, and 6 to 12 months later, we're in a recovery. So I think, Mike, if I'm right about the slowdown, and I think, is there a risk that a recession could show up sometime next year? Yes, it's just not in the tea leaves quite yet, but I don't think we're going to see a major, if you will, repeat of 2008 until maybe 3, 4, 5 years from now, because the unfunded liabilities of the federal government, the amount of debt, not only in the U.S. but around the world. One of the stats to me that is most scary, in 1982, for every $1 GDP, the U.S. total debt, and this includes the government, corporations, households, was $1.60. We're now at $3.40 of debt for every dollar of GDP. So we've used the accumulation of debt over the last 30-plus years to power demand and lift GDP growth. But at some point in time, you reach that point of no return where each new dollar of debt generates less and less in GDP. And that's really what's been happening in the last 10 or 15 years. And it isn't just in the U.S. Some of the statistics